Hello, what you're looking at right now is the EURUSD 4-hour candlestick chart. It's a naked chart, meaning that I don't have any indicators on it, and that's because I trade primarily using price action and more specifically supply and demand concepts, a little bit of FOMC, but I won't really go into that. In fact, what I want to go into for this video is actually fundamentals. So for example, let me show you fundamentals. It's this, and it's a little bit of this, and it's a little bit of this. So that's kind of where the fundamentals show up in my technicals, if you would allow me to say that. But essentially this video is me trying to go through and just to really journal down my thoughts when it comes to the fundamentals that I look out for when I'm trading this particular currency pair, which is EURUSD. Let me just write it down. EURUSD. Okay. So the very first step is to simplify all the news flow, all the different headlines and all that. And what I will do that is, how I will do that, is by really drilling things down to the main themes in the market. And I find that these tend to be broken down into three main themes, or three main, I call it big picture drivers, and they tend to be simplified to growth, meaning the economic activity globally, central banks or policy in general, as well as geopolitics. So this is currently a little bit vague, but the idea of bringing up these three drivers, or these three main moving parts of the market, is that I want to find out how the market is feeling. I want to find out what the market sentiment is, the market tone, the risk trends, the risk sentiment, whatever you call it. I first learned this during one of my internships, and it's the idea of risk on and risk off when it comes to the macro and FX world. So particularly what to take note of is that, in risk-off environments, people are very scared, and they tend to go to assets that are more secure, that are more safe. And this would be things like your gold, your US dollar, which is your reserve currency in the world, and also currencies like a Japanese yen will appreciate. This is due to also the unwinding of the carry trade. And you also have this thing called the risk-on environment. So what this is basically when people are more confident about the economy, they're more confident about the market conditions, and they're more keen to put their money in riskier assets like US stocks or your higher yielding currencies like your Aussie dollar and whatnot. So essentially, just to get an idea of how the market is feeling, you can just take a look at whether things are a bit more risk off or a bit more risk on. An example of how one of your big picture drivers can cause a risk off sentiment, for example, would be, say, in 2019, when you had a lot of announcements by Trump on tariffs and whatnot, and this suddenly caused really huge declines in the market, right? So that was your risk-off environment. Alternatively, you had COVID in 2020, so in early March last year, or in about late February last year, when COVID first came out, people were really scared about the shock to the economy. So this caused also a very strong risk-off environment. On the flip side, or conversely, in say April this year, people were very we're getting more confident about, say, vaccinations and economy reopening. So once again, growth and constant risk on environment. US stocks kept going up, US dollar kept going down. So I will probably explain this in greater detail, maybe over several videos. But essentially, the idea is just try to figure out what's going on with the news, what's going on with the world, break it down into these three themes. Sorry, I keep doing this. And also to try to figure out whether things are leaning more towards red or leaning more towards green. So something else that I find will be quite interesting or useful to highlight would be this idea of framework called the dollar smile. It's basically developed by different, analysts over the years to sort of simplify this complicated creature that is the US dollar. And why it's complicated is precisely because of the fact that it's a safe haven currency. So just to backtrack a bit, safe haven currency meaning that, in risk-off environments, it will tend to appreciate. So, simple example, if you go to the left-hand side here, if the US economy is doing really well compared to the rest of the world, it's pretty expected that the US dollar would appreciate compared to other currencies. So that's pretty much, understood. If you go to the bottom part over here, and you find that when the whole world is growing, so the US is growing, the rest of the world is growing, and this becomes an environment of synchronous global growth, then what happens is that the US dollar actually declines, and we have seen this in the past, particularly in say 2017, which was one of the worst years for the US dollar. Then you'll see over here that on the flip side, if the US economy is down, the rest of the world is doing badly, this actually makes the US dollar tend to appreciate. I mean, we've seen in the past that in such situations, the US dollar will actually have a great time. So this is just something to take note. It's not a given that it will always be this way, but it's something that's interesting to take note because of the unique characteristic of the US dollar, given that it's a risk-off currency. It's a flight to quality currency or a safe haven currency. So over here you see the 15-minute chart from where we began the week. We began the week around over here, start of August. I just want to highlight this thing called the FOMC. So for those of you who don't know what the FOMC is, it is basically the central bank meeting that happens now and then. It happens frequently, regularly. You can check the calendar. But essentially there was one in June and there was one in July. So the point that I really want to highlight is just that the June FOMC one was really big. And as you can see, the knee-jerk reaction was a lot more conspicuous than the July FOMC, where they didn't really do so much on the knee-jerk. In fact, it just kind of provided the catalyst for what was a pretty overdue recovery. Price had been decelerating for a while. As you can see, the bearish pressure was beginning to exhaust, and it was kind of about time for price to kind of recover a bit more. Of course, we do see a much stronger indication of a trend change. Here the price is the trend is clearly still down. Here we're seeing a bit of a clearer indication that price is in the process of recovering. So this July Fed meeting did provide the catalyst for that, but you can see there's a very big difference in the initial reaction, and the reason why is because of the June FOMC being a very significant one. So the Fed, the US Federal Reserve, very important topic, very important to take note of in the financial markets, particularly in the FX world and especially for the US dollar. And one thing to take note of is that central banks have been super influential since the 2008 financial crisis, and we saw a bit of deja vu last year with COVID, when the central banks all came in and with all the huge suite of emergency measures. So the bottom line right now for understanding central banks, and once again this ties in with the big picture driver, which is central banks. As you can see, once again in 2021, it's all about central banks normalizing policy as the big picture driver. So bottom line is that the Fed has been in emergency mode. Sorry, my voice. The Fed has been in a state of basically the tools that it deployed last year during the height of the crisis. These are not normal. These are like emergency support measures, and the economy has been getting better. Things have been looking up, and the Fed can't stay in this mode forever. Because right now, interest rates, its Fed funds rate is at 0. It's like back to like extreme conditions, extreme crisis days, is back to 0. And QE right now, meaning the Fed has started to, last year since the crisis, when you hear asset purchases and whatnot, that's another way through which the Fed has been trying to stimulate the economy. And this is pretty complex, so I wouldn't go into the details, but essentially if you hear things like asset purchase program, purchases of US treasuries and mortgage-backed securities, is basically referring to that. Right now, the key figure is 120 billion USD a month, and the idea is that this will have to be rolled back. So right now, the market is obsessed with this thing called the taper talk. Yes, so what this thing is just to recap, is one of the main tools. Sorry, not taper, but taper would be the opposite of one of the main tools that is currently in an emergency state, a very unnatural state. That is not what a healthy economy usually has, which is why the Fed is trying to roll back, because it doesn't want an economy that will overheat. Because when the economy is so strong and it starts to overheat because there's too much help given to it, this will threaten your price stability, which is your inflation. And if your inflation gets too high, that's also very problematic. So that's what the Fed is concerned with. So the thing is, the markets really love when the Fed is very accommodative. So in other words, all these emergency measures have been very supportive for the markets. They've been really good for the markets and very good for risk sentiment, very good for risk attitudes. But the Fed can't sustain that forever, and the market knows that as well. So right now it's just a matter of the pace. Is the Fed going to move faster in rewinding all these? And if it does, that's what's going to cause a bit of a shock to your risk sentiment. It's going to cause a deterioration in your risk-loving appetite, which is what we saw actually in June. So this is why June was so important, because it signaled basically a Fed that is more willing to move faster than what the market was expected, and move faster as in rolling back, rewinding these emergency measures. So that was what we saw in June, and why the Fed did that is because based on that assessment of price stability, inflation dynamics, as well as full employment, or the labor market dynamics. Basically, what they concluded was that okay, I think we can move faster than we can kind of step things up a little bit. And even though the market was kind of expecting the Fed to move faster, they didn't really expect the Fed to move as fast as what it was signaling. So you'll see this, if you see this key, this phrase called talking about tapering. And then from June to July, we saw the conditions in the economy kind of get threatened by the Delta spread, increased cases. So that led the market to wonder if the Fed would continue to be so optimistic. And well, the Fed didn't scare the market by doing that. So it kind of helped the market by saying that we still prioritize growth, we still prioritize the economy's recovery, and we're not going to prematurely roll back the recovery. We're not going to prematurely roll back all these support measures if the economy is still struggling. So this helped the market in a sense, and euro was able to take off, as you can see over here. So it was able to from the green circle. So you can see that it was able to firmly recover and follow through into Friday and into the start of this week. So the FOMC meeting is a very major risk event, but at the same time you also have a lot of intraday, more frequent, smaller risk events like your data releases, because this will help your Fed to form a picture of how they are doing with respect to the goals of inflation, of a stable inflation, as well as little unemployment as possible in the economy. So for example, the different data releases that they will be concerned with would be for your inflation reports, and there are different types of that, but the one that they're most concerned with is this thing called the PCE, or core PCE, but of course it's also CPI, and then this has a lot of links to the current ongoing very thematic discussion of whether inflation is transitory. So that will be a huge topic of its own. And then also you have the full employment, so you have the data that relates to the labor market. So for example, this would be your monthly NFP report, which is your non-farm payrolls report, which is something that FX traders love. But you also have other different data points that can add to the picture. And other things that you would also look out for as a trader would be when the Fed speakers go and talk on TV, when they give press conferences and whatnot. And that's exactly what we saw this week. That caused a lot of volatility in the US dollar on 4th August, Wednesday. So we had a very weak ADP report, basically a jobs report where the added jobs were half what was expected, which is very bad. And this caused US dollar to decline. When US dollar declines, EURUSD goes up, as we saw over here. And then after that, shortly after, we saw an ISM services report. So this is the institute that publishes data on the services sector of the economy. And this is a very big portion of the economy. I think it's about 70% based on this, 70%. And so strong, very strong. And the Fed speaker Clarida also kind of shocked the markets a bit by being more aggressive in reducing the measures, basically more hawkish than expected, and this also caused dollar to appreciate very strongly, which is why we got this over here. So as you can see, fundamentals were very, very important on 4th August. And also on on Friday, we had our favorite feature of the week, which is the NFP. This basically catalyzed the follow through and the bearish pressure over here. NFP report was very strong, above 900k drops added, way above, not way above, but still above expectations. And this was, of course, USD positive, but in general, it just helped to boost what was already a falling market for EURUSD. So that is it for this week's review. Just a little bit on the fundamentals, a bit more of a US dollar tilt, otherwise the video will be too long. But okay, so to give a summary, first of all, just find the biggest macro themes that are going to influence your market tone. And if it's a risk-off environment, you can have implications on the US dollar because it's a safe haven currency, which is why we talked about the dollar smile. Among the three big picture drivers for this year, I would say that the biggest one is linked to central banks because of how crucial they've been in terms of providing support last year during the height of the crisis. So when they're now going to roll back all this support, it's going to be something that the markets will watch out for. Especially for the Fed, what they want to focus on would be the taper talk, which is the most immediate unwinding of support. Particularly, you want to watch out for the Fed speak as well as the high frequency data points, which will express how the Fed is viewing the situation with respect to the goals of price stability as well as full employment. So you look at things like inflation data, your CPI, core PCE, as well as your labor market data when it comes down to your NFP and whatever reports like your unemployment report. And what we're going to focus on moving forward would be whether we're going to see more taper talk in September or in Jackson Hole, which is in late August this year. So that is it for now. I'm so sorry this is not the most clear video, but I'll make more videos and hopefully those will be a lot better. Good night!